In this video, we're going to go over everything about fair value gaps. We will talk about what causes fair value gaps, why price is attracted to fair value gaps, and we'll also cover a strategy that combines low time frames and high time frames to enter and exit trades from these fair value gaps. Without further ado, let's get into it. First, we need to define what a fair value gap actually is. These gaps can be bullish or bearish. Essentially, a fair value gap happens when the price surges or drops sharply, resulting in a large candle. In the bullish example, when the price shoots up rapidly, it forms a huge green candle. This extreme swift movement doesn't give sellers a chance to react, leading to what we call a market imbalance. And the market will typically want to revisit this zone at some point, for reasons we'll go over in a bit. To identify a fair value gap, you mark the top wick of the candle before the significant move and the bottom wick of the candle after the move. This marked area is the fair value gap. When you look at your chart, you'll see these gaps are quite common. Often, the price will revisit this area, correct the imbalance, and then climb back up to retest the highs, allowing us traders to take advantage and profit from these movements. Okay, but why is the market attracted to these fair value gaps or imbalance zones? Well, to understand that, we need to understand what goes on at the market structure level. Imagine a scenario where a bullish candlestick sequence creates a significant imbalance in the market in a higher time frame. If we took a closer look by zooming into a lower time frame, we would likely see a bullish structure similar to this. The price had formed successive bullish structures to the upside, driven by high buying pressure and a lack of sellers. The sellers who got defeated in this bullish move would often place buy limit orders below key zones like order blocks and demand areas. They hope for a deep pullback to activate their orders before the price resumes its upward movement. These untriggered buy stop orders lead to an accumulation of liquidity in these areas, creating a significant liquidity pool inside the fair value gap. The market needs to come back to this zone and sweep the liquidity formed in this area before it could continue on. In simple terms, fair value gaps are zones that contain large amounts of buy limit or sell limit orders. The presence of these limit orders is what attracts price back into these areas. Okay, but how does all this help us trade better? Well, understanding the psychology behind fair value gaps allows us to anticipate future price action. If the price respects the fair value gap by refusing to go lower and displays signs of upward movement, it suggests the price is likely going to continue its upward trend, aiming to reach recent buy-side liquidity levels. On the other hand, if the price fails to react to the fair value gaps and goes right through it like in here, it's likely that the price is aiming towards sell-side liquidity accumulated even deeper below. Alright, so which fair value gaps are actually tradable? The market creates thousands of fair value gaps every day, on practically every time frame you could think of. But which of these gaps could we actually use to enter trades? Well, here's how I trade fair value gaps. Firstly, you have to identify a strong market structure break. For example, here, after a nice downtrend, the price fails to make a lower low. Instead, it breaks the lower high to the upside, creating a market structure break with huge pumping candlesticks. These candlesticks that are responsible for this market structure break should have fair value gaps in them. In this instance, we actually have more than one. Now, the riskiest entries are actually the imbalances closest to the break. The imbalances between the lower low and the break have mid-level risk. The ideal fair value gap is a fair value gap that is created right besides an order block. If you don't know what an order block is, I recommend you watch my previous upload. I'll link it down in the description. Alright, so as I was saying, a fair value gap that is created next to an order block could be an extremely powerful entry zone. If, for example, the order block and the imbalance overlap and create one big zone, this is considered a golden entry zone, and the price is very likely to reject from this zone when it comes back. If you're confused, don't worry, we'll look at plenty of real trading examples along with a complete strategy that you can start using starting today. But before that, let me tell you about the simple formula. If you're like most traders, you've probably spent countless hours searching for that one profitable strategy. You watch tons of YouTube strategy videos, jump from strategy to strategy, and yet you're just unable to find that winning indicator or strategy. Well, if this sounds like you and you're wondering why this sounds familiar, it's because I used to be in the exact same place as you. And I get how horrible this feels. You waste tons of money and worst of all, tons of time. That's why I developed the simple formula. This course explains a powerful trend-following day trading strategy for trading futures, stocks, commodities, and Forex. The simple formula is easy to understand and to trade. This approach doesn't require complex trading software. Basic charting tools like TradingView is all you need. Thousands of traders have used this strategy already. Don't miss out. Get instant access now for a limited time. Alright, so let's create the ideal trading setup using fair value gaps. The first thing I look for to determine if a fair value gap is valid is whether it came from a market structure break or an MSB. In this example, you see that the price broke this lower high with this price swing right here. This pump also created several fair value gaps, as you could see. The second thing I look for is the proximity of the imbalance to the order block. You'd want them to be as close as possible, essentially forming one overlapping zone. As you could see in this example, the fair value gap is formed right next to the order block candle. This is what we're looking for. The closer the imbalance candles are to the order block, the stronger this zone becomes. In other words, the price is very likely to bounce from this zone. The last thing I look for is a steady pullback to this zone. Now, this isn't exactly a quality of the fair value gap itself, but rather a quality of the trading setup. But nevertheless, it's important. You want the price to reach the fair value gap in a steady and controlled manner. If the descent to the fair value gap is aggressive like this is a bad sign, and you should stay clear of this trade. However, note how I say steady and not slow. Very important difference. Sure, price needs to reach the fair value gap steadily, but that doesn't necessarily mean slowly. In fact, what I found in my backtesting is in instances where price took a very long time to reach the zone, the order block ended up not working. So ideally, you'd want a steady descent or ascend to this zone like in this example. Nothing too drastic or too slow. Alright, so how exactly do you enter the trade? Once the price reaches this zone, you can enter the trade in several ways. The first, but the least effective method is to enter the trade using just a single time frame, such as we have done right here. What you'd want to look for is a strong reversal candlestick pattern in the entry zone. You can use a hammer pattern, Morningstar, or a gravestone doji to enter this trade from here. As you can see in this example, the price was rejected from this zone after forming a hammer candlestick. You'd want to set your stop loss at the bottom of our golden zone and target the liquidity above for your take profit levels. However, this isn't my favorite way to enter these trades. The setup works sometimes, but tends to fail often. Also, entering using just one time frame means that the risk to reward ratio for the trade is also quite low. There's a much better way to enter this trade, but it requires a bit of patience. So a much better way to enter a trade like this is to combine the high time frame with a low time frame. Let's look at a new example. Here on the 1 hour chart, you could see that the market created a nice golden zone, which again is basically a strong MSB with a fair value gap and an order block overlapping each other. After spotting the setup, we should drill down to a lower time frame to set our entry. Since we are on the 1 hour time frame here, we'll drop down to the 5-minute time frame. Again, nothing magical about the 5-minute time frame in particular. You could even use the 15-minute or the 1-minute if you'd like. Okay, so on the 5-minute time frame, you'd want to see the same setup you saw on the 1 hour happen again here. Remember guys, the market is fractal, which means that it creates the same structures and setups in every time frame, and we can make good use of this. Okay, so we see on the 5-minute that there is a strong MSB. We also see a fair value gap has formed overlapping the order block candlestick. This is a mini golden zone created inside the larger golden zone. The setup is very clear. We'd enter the trade as soon as price comes back to this mini golden zone. You can set your stop loss at the bottom of the mini golden zone, and you could target the liquidity above for your take profit levels. As you can see, this gives you a much more certain setup and a much better risk to reward ratio. The price reacted from this zone very well, and we had the perfect trade. If you want to see more videos like this on price action and smart money concepts, hit the subscribe button and leave a like on this video. See y'all in the next one.